Happy Wednesday, everybody. Here we are. It's Webinar Wednesday again, and this is going to be a great one. You all know on our screen here, the sales success team, Mr. Alex and Reef both. And we have a special guest, Mr. Michael Tannenbaum, with us today. So,
Hello.
Michael, yeah, so awesome having you here. And before we dive in and really pick Michael's brain here, which is really what we want to do, I want to highlight a couple things for everybody. Number one, remember some housekeeping items here. Any questions you have, Alex, we're using the Q&A.
That is correct. So all questions, please post those in the Q&A chat. If you are watching on LinkedIn, you can post those in the chat. I am monitoring it as well, and we will get to those questions later on in the session.
Yeah, and Reef, if you can help manage that as well, as usual, would be great. Before we dive into this, I just want to high level remind everybody, we did something here that I think we're all pretty excited about. A few weeks back, we actually enhanced and launched very much improved pricing for first lien HELOCs. And a lot of you may think, well, why in the world would I do a first lien HELOC? So here's some food for thought that I want to give you guys all. The challenge to you is to remember this. If you have a client, owner-occupied, investment properties, whatever the case might be, that do not currently own anything on their homes, make sure you understand first right out of the gate, the need for cash is real. That there's no doubt about it. The need for cash with our homeowners in this market is very, very real. So I want to encourage you all to use the lead portal and the inquiry tool to price out the first lien HELOC. And I'll even challenge you to compare it to a traditional agency loan. Now, why would I say that? I say that two reasons. Number one, there are loan level price adjustments with the agencies that anytime there's cash out, we all know, I'll just use the word egregious in the loan level price adjustments. The second part, which is maybe even the most important, is that when you go to do a loan amount for a zero lien property, it's probably a lower loan amount. And as a result, the compliance, or should I say the high cost rules in agency loans really restrict your ability as loan originators to do those loans. We think our first lien HELOC pricing is the solution for that. So I want to encourage you all. That's my little plug as we go into this webinar now. Again, I'm thrilled to be able to introduce again Michael Tannenbaum, our CEO. And Michael, I'll just say it's been almost a year since you've come on.
Yeah, no, for sure. It's been good.
I think I looked and I think it was April,
Right.
I want to say. And so a little bit about you, you've been in this industry for a minute. And so what inspired you? Like, as you looked at Figure as an opportunity, what inspired you there to come our direction?
I think for me, it was a couple things. One is Figure's clearly done something really special and unique on the process side of things. Not only is it using blockchain in new ways, but also standardization, automation. So I think at a very high level, I was excited by the fact that Figure was doing a new product, a mortgage product, a regulated product in a way that was different. You think about HELOC from say 10 years ago, and you think like, oh, some sign in a bank branch about kind of a rainy day option that you tap. But remember, I came from SoFi, earlier. I was there from 2014 to 17. And we had this big personal loan business, and 50% of those people were homeowners. And I remember at the time speaking with Mike, the founder of both, and saying, why are these people who are homeowners, why are they taking out these personal loans at such high rates? And the answer was around speed, right? It's because they probably could have taken a HELOC, but they didn't have time to go through that process. And, HELOCs weren't really online. They were kind of a branch-based product. And I think Figure took a HELOC and reimagined that. But what they did and what we've done, is more than that, right? It's more than just HELOC. You in fact, were just talking about first lien, right? It's more about the process, and the cost to originate a mortgage has gone 3x since the financial crisis. It's almost $12,000 now, and we're doing this in $500, right? So that was really exciting to me. And since I've been here and seen the decisions that we've made and the automation that we've delivered, I think it's been even more manifest.
Michael, I love the answer there, and I will just share with you personally myself. I came on just before you, right? We've
Right.
been here roughly about the same amount of time. And one of the things that I personally got so excited about, having been in the loan origination side of this business for 25 or so years, I saw that the industry, there's a massive need for a change. In other words, the way we've always gone about funding loans, doing loans, secondary and capital markets with loans, all of that, the industry, in my opinion, is just screaming for a change. And I got really excited about coming on to Figure, using your words, because of that process. And I will tell you that we've received feedback from some of our partners and loan originators. They'll make this simple comment: man, I wish I could do all my loans this way. And that, to me, is the magic. That's the
Totally.
right answer, right? And so you've come on board. We had HELOCs. We'll talk a little bit about some additional products and kind of where your thought process is on that. But I'm all of a sudden seeing us, to the first lien conversation, I'm seeing us expand, right? It's not just solely the HELOC conversation anymore. And you mentioned something a bit ago, and I think there's a lot of questions about this. I've been in meetings with you recently, and you've made the comment there's a lot of buzz around this topic, but you used the word blockchain. And so that's new, right? In this industry, at least to
Right.
me, very new, very exciting. So talk about that a little bit. What is that kind of
Sure.
enabling us as a company to do?
Yeah, I think from a high level, mortgage is one of the places, but other consumer lending is it's true, but I think with mortgage it's most true, is that loans tend to move around between many owners as they mature and go through their life cycle. And I think mortgage is probably the most, because you have this whole concept of servicing, release, retain, you have agencies, you have aggregators, and you have this whole world where mortgages move around. And consumers feel that frustration, as their payment details change and all that. But also, the whole industry feels it, right? Because there's all kinds of data moving around. There's all kinds of confirming and reconfirming of data. Was this person really a 730 FICO? Show me the report that says that. And now I bought the loans. I want to confirm that, and I want to check that again. And there's all this checking and confirming and reconfirming and ownership movement. And if you think more broadly, what are things that blockchain does well? I think ownership, registry, and making data immutable such that you don't need to re-verify and confirm things multiple times. You can we have this phrase at Figure, which is truth over trust, right? So don't make it that you have to trust. I think the way the mortgage industry has worked historically is, I think Tim's a good guy. He seems credible. He's got a nice voice. He's got a nice microphone. I trust what he's doing, right? And that's worth something for sure. But if I just can confirm that these things once and make sure that they're true and validate those in a way that they are hashed or etched in a database that is basically unable to be adjusted, I think that's a clear example of where you don't need to do and pay someone to do all these double checking and confirmation. So we've seen like a 70%-ish reduction in third-party review for people that use Figure because of the automation, the standardization, and the blockchain.
Well, you mentioned a few minutes ago, you mentioned a cost per loan basis. Would you say that this is one of the areas that clearly allows us to keep a cost per loan basis extremely low, to exactly what you just laid out?
I think absolutely. It is. And it's one of I think another great example is Dart. I don't know if that's something you've covered as much,
Not
but
so much.
yeah, I mean, I think it's also another really clear example of cost saving and also blockchain, in the sense that loans, not only do they move through the capital markets and people are re-verifying, but as their ownership changes, that's something that we've built a product that automatically listens for those ownership changes and updates those with a registry process with the county. So just as every time the loan changes hands, people are used to using either a manual process or using something like MERS, which requires you to be reactive. For us, this is a proactive solution that says, because of the activity that's happening on the blockchain, I'm aware of where the loan is. I'm aware that the ownership has changed. I see the trade and I update it automatically. So I think that's another nice example of savings and automation that comes from the figure process and the way that we do things a bit differently.
Here again, I think it's truthfully on a very large scale, looking from 30,000 feet down. I think it's really a game changer with the way our industry has always approached things. You know, I share, and so does the team with our partners LOs on a pretty regular basis, that if I'm being honest, sometimes you go in, you do the inquiry inside the lead portal, and you might even see some frustration, or maybe loan originators don't understand. Well, if I was doing an agency loan, I would just write a letter of explanation as to why someone's credit is what. Do we do those things? No. Can it be frustrating? Yes. But I want to really drive this point home. It's also what creates so much strength for us as a company, because
Absolutely.
everything we do all lives in the same, everyone goes through the same process, I guess is the way of saying that. Is that fair?
Totally.
Yeah.
Definitely. Well said.
It's very transparent. It's very, you know, I think from a behind the scenes and investor and cap market standpoint, that it strengthens who we are. The fact that we do things this way, right? And we don't bend too far from it. So digital lending in the future. What do you think, Michael? It's been almost a year. Where does your head take you there when I make that comment? Digital lending into the future. What does that start to look and feel like?
Look, when we talk about HELOC and as a product, and it's only 10 years ago, how different such a big category was, I think you realize that we're still kind of in the innings of changing the way that lending works. I think Figure is done two things from a technology standpoint, from my vantage point in the past year that we've focused on. One is we've continued to offer our embedded or B2B model, which has been a huge unlock because I think it's allowing us to really focus on automation, standardization, capital markets, and leverage the really strong sales force and brands of many of our partners. So I think from a kind of future of lending and future of finance, that's a new category where you haven't really seen people that have done it exactly in this way. And you can imagine how powerful that can be because we can solely focus on getting the thing that we're best at right and not necessarily having to focus on areas where we're not as differentiated, right? We don't have the history, the sales culture, the branding of some of the really great partners that we work with. And so that's I think kind of the specialization and the focus there has allowed us to really improve the product. I think number two is that we're trying to expand the aperture of what we serve. I think HELOC, it can feel, at first glance relatively narrow. You think, okay, makes sense for the set of people who have a low interest rate first and want to take out additional funds. But in reality, we know 40% of people own their home free and clear. And
Yeah, it's a big
those
number, isn't
people,
it?
which is
Yeah.
amazing, right? It's
Yeah.
it's unbelievable. And there's a huge number of these smaller balance mortgages that are outstanding. And we have the automation, the speed, similar to where you open the call, the cost advantages, all those things matter most when the loan is smaller, right? Because there's where a $500 appraisal, $1,000 or $2,000 title insurance or report, that's where you're starting to get three points just on the loan before you even get into fees, right? So that I think is a huge area for us is saying, how can we extend this core process that we've built, that we've helped partners use, and move into other areas that are not just a second lien? And that includes, of course, piggyback. That includes the first lien that we've talked about. That includes new products. So I think this kind of embedded model focusing is definitely really helpful. Might be worth having a quick conversation on AI as well, Tim, if you think that makes sense.
Yeah, actually, it leads me kind of to my next thought here that popped into my head is in your role, and I know you're not doing this single-handedly, you've, in my opinion, already, you've done an incredible job building a team of folks around you. And with yourself and said teams, what's the process? What does it look like when we start having conversations around fostering innovation, market conditions? I think First Lean's a great example of that, right? We saw a need, and you have really been driving that point, which has gotten us to where we are now on that First Lean topic. But what's the day in the life of Michael and team look like when it comes to thinking of market conditions, fostering new innovation? What drives that?
Honestly, look, I mean, this call, you and your team is a perfect example of that. I think, I've been a part of a few companies really early. SoFi, I was 70th person there, obviously got really big, and I was part of growing the mortgage business, from its infancy. I was a part of a fintech company called Brex, corporate credit card, first person there. So I think when you learn but in these environments is how you can sort of see the different inputs, whether it be customer feedback, employee feedback, market feedback, and opportunity. And the advice that they give in Y Combinator, which is like this relatively famous startup accelerator where a lot of startups have gone through, is they say, look at where your product is being pulled, right? Try to see the things that are kind of happening, even though you're not doing them. And
Okay.
then follow those threads, right? So First Lean being a good example, we didn't design the product, we didn't design our process and our product for First Lean. We designed it for Second Lean, but people started to use it. And so one of the things that I noticed when I got here is I'm like, well, that's interesting that call it 5-7% of the volume is First Lean. Why is that? And it's funny because actually a lot of investors didn't like it because they said, oh, those people must not be smart, essentially, right? They're taking out loans when they could get a cheaper, or at least they thought cheaper cash out.
Right.
Right. And I'm kind of thinking, well, that's a lot of people to be that dumb. I don't know. Right. And you could sort of argue that that's like saying, well, any personal loan, going back to where we were already in this conversation, why is any homeowner taking a personal loan? Why is any homeowner borrowing on a credit card? Right. Circumstances, convenience, ease, a whole host of reasons. Right. And so I think I wanted to kind of pursue that thread of why is that happening? And we start to have conversations, right? Talk to you, hear the feedback you're hearing, talk to Anthony, talk to what we're seeing on the customer side, talk to partners. I think it's important, we are B2B as a company. And when you are, it's important to kind of be in tune with your partners and listen to what they say. And I think you especially have done a great job trying to be that voice of the partner ecosystem to make sure that we're always delivering and improving the product and listening to feedback. We can't, you want to do some of that. Of course, there's also the famous line, ask people what they want and they say faster horses, right? There's some validity there too. That tends to be a more consumer mindset though. I think that clearly is the mindset we took when we changed HELOC altogether. But as we're improving and making improvements on it, I think we're doing more of the follow the thread and see where the product is evolving.
So, Michael, I'm going to make a comment. You've never heard me make this comment before. My team certainly has, and it's all good. But I would just tell you from a loan originator perspective and approach, and I try and promote this with our partners and our sales teams and everybody logged on listening here, and decipher what I'm about to say. And that is this: I've never ever believed that one of my past clients or future clients calls me solely because of what a rate is. When I'm talking to a client, there is a need. And my job as an originator is to educate and advise and therefore strategize as to what's the best product to fit that need. Now, as I said that, tons of originators just heard me say that rate doesn't matter. That's literally the response I get when I make that comment. I'm not saying rate doesn't matter. I want to drive this point home. What I'm saying is it's not what the need is of the homeowner. And make no mistake, there is a need. And I'm so happy to share this quick story. I invited both Alex and Reef on a call with one of our partners LOs late last Friday that was trying to decipher on how best to help one of his clients own the property free and clear, one of those 40%, right?
Right.
And they have a need for cash, and it was going to be $100,000, whatever it was. Lower FICO borrower. Okay. So in the agency terms, they would have had to actually, because of the FICO, they would have had to go with a government FHA loan. The interest rate was 8.25%, along with all the closing costs that come along with that FHA loan,
Right.
versus our HELOC, which, by the way, was a considerably higher rate than that 8.25%. And we helped him, myself and team, we helped this loan officer with a mortgage coach report, compare them side by side. I received an email on Monday on the holiday from the loan officer saying, how do I move forward? The borrower wants to do the HELOC. Now, here's why this was so powerful to me. The rate was higher. And a lot of loan originators will say, oh, no, they're not going to do that. The rate's too high. I want to encourage loan originators to understand, don't sell yourself out of helping the borrower. Let the borrower make the decision. Educate, advise, and strategize. And it's not all about rate. And yes, rate is important, so don't misunderstand my statement. But that's what I love about using the lead portal, the inquiry tool. I say it all the time. Start there. Is it going to work for every single one of your homeowners? Of course not. In fact, I don't know a lender that has a loan for every homeowner in the country. Wouldn't that be awesome?
Right.
So, keep it in perspective, help control the narrative, strategize with the client. And so I just love all of that about what we're doing. And so you mentioned customer experience. And in our world, Michael, that customer is the LO.
Right.
And I'm happy to report that I just came off of a meeting that you were on, Michael, and you said very clearly, I want to put the efforts in how do we best support our LOs. So number one, kudos to you. I love that. Everyone on the call, please understand this is from the very top leadership of our company on your screen right now. And that I literally just came off a call of you making that comment, Michael. So thank you for that.
No, I mean, look, the reality is that's, the LOs are out there using the product, and they're using the product every day, multiple times a day, multiple times a week and month. And that's the core customer. And I think when you think from a customer support perspective, every customer is important, every customer is right. That's the mantra, right? But you are forced to make priority decisions. And I think the reality is we need to make sure that our most frequent and most important customers are supported.
Yeah, it's a great point. And I just love that the direction everyone that's attended webinars in the past. We're by the way, Alex and Reef, we're actually coming up on 1 year since we started our webinar
I know,
series.
it's very exciting.
We
to me.
actually surpassed a big milestone already going into this year. We've now total had almost 2,100 attendees on our webinars and 2,700, almost 2,800 register. So kudos to you, Alex and Reef, for continuing to push on this. I think that's great, right, Michael? I mean, we're,
Definitely.
people is just a standing every other Wednesday type call.
Yeah, you honestly say it best, right? We're in the business of helping people. Loan officers help their clients. We help loan officers. So
Yeah.
we'll have to do something special for the 1 year anniversary, I think.
That's right. Yeah. When we hit that 3,000 number, maybe we'll do something big. So as we look forward, Michael, we've talked a little bit about first liens. You actually briefly mentioned piggyback. It's actually something we're continue to lean on. I will share with you, I'm very excited about that. Yes, for purchase, but I'm actually most excited about it for refi, which might sound crazy. So anyone listening, be sure you reach out to our sales success team. You all have our information. And we'll follow up, but we're rolling that out piece by piece. And so we're pretty excited about that. By the way, I'll just give a plug for the refi aspect of it. I want to encourage you all to remember that if a borrower has a current 3% or maybe even sub 3% mortgage rate, but they have a cash need, or maybe they have a 7.5% rate, they bought their house 2-3 years ago, you could rate and term and save them money. What you can't do is save them money if you add cash out to that loan because, again, of the loan level price adjustments. That's where I think a refi opportunity with a piggyback scenario is going to be very powerful. Again, just another strategy to help. I'll just share with everybody as loan originators, if you don't know this, I've done some comparisons, and when you do a cash out, the loan level price adjustments, we know climb. The loan level price adjustment for subordinate financing, regardless of CLTV, up to 89.99 is 0.625. That's the only loan level price adjustment that exists when adding and going to a CLTV behind a rate and term first. So keep that in mind. Think of us as a resource there. But beyond that, Michael, what do we think? I know there's talk of some additional products. You want to talk about that at all as we push through the year?
Yeah, I think the approach that we're taking is that, as we've been saying, we have more than just a HELOC flow, right? We really have a new way of doing a mortgage. And if you look at how we do income, for example, it's bank statement essentially, right? Connecting with Plaid. Obviously, we support payroll, we support pay stub. But in general, we're not that far from a bank account type underwrite that you would see as a traditional first lien non-QM product, right? I think non-QM in general is an area where we see ourselves moving closer to, especially because that tends to be an area that doesn't have as much support from the existing loan origination systems that our partners use. And so our goal is not to be a software provider, right? We don't view ourselves as competing with Encompass. But I think what we do view ourselves as competing with the process that Encompass and Fannie Mae collectively have, right? And we see ourselves as a faster, more streamlined loan process. I think especially outside of the conventional space, so pushing more into non-QM, that's an area where partners constantly say to us, we'd love to see you do more. Encompass isn't totally working. We don't have the takeout or the guarantees. We're kind of matching between a bunch of different investors. And so from our standpoint, I think broadly in non-QM is an area where you're going to see us launch more because our product is close on matters of underwriting. Our product is close on the process side of things. And I think that's the focus, at least for the medium term for us, is kind of expanding beyond just HELOC and helping our partners do more of the broader non-QM origination.
Well, I'm so glad you said that. And I know that Alex and Reef are both laughing here because I will tell you that the conversations we have on a regular basis is totally surrounding the process. And here's how we like to talk about it. Adopt the process of lead portal and inquiry tool and know that right now today, the result of that process will be a HELOC. However, what really becomes important is adopting the process. Today, you'll get a result of a HELOC, but maybe in a couple months, it could be DSCR. Maybe it's that first lien pricing. Maybe it's that piggyback. So adopt the process and understand that the product offerings may look and feel different off into the future. Is that fair?
Totally. And I mean, DSCR is a perfect example of a product that we're close to rolling out. And there you have, we already serve investment properties on the HELOC side. So it's, again, not that big of a lift to say, well, let's try to underwrite those investment properties based on the cash flows of the properties, not necessarily the owner, right? So that's another example of where we're pretty close and we're just trying to see where the product is kind of being pulled and go from there.
Do you see any headwinds or how do we deal with teams deal with any regulatory concerns or issues? I mean, I'm certain we have teams of folks focused on that, but is that a big concern at all?
Look, I think operating in the fintech space, operating in the mortgage space, it's obviously regulated. I think that mortgage is the most complex regulatory product complex product from a regulatory perspective. We take that super seriously. We've had a lot of investments in compliance, in legal. And I think that the opportunity, of course, is to look at areas where you can innovate. When you think about what is required to innovate within fintech, you need legal and regulatory, you need technology, and you need finance, right? You can't have any of those three missing. If you don't do technology, you're not innovating. If you ignore the regulatory, you're breaking the law and you'll go to jail. And if you don't understand the finance piece, you'll run out of money pretty quickly when nobody's interested in buying what you're doing, right? And this is, you make 10 loans at 70,000 each, and you've quickly blown almost $1 million if you can't sell those, right? And so this stuff adds up quickly. And so, for us, legal and regulatory is one of the three legs of the stool. And it's not a four-legged stool with a missing stool. That's top delivery.
Right.
It's kind of a tripod, if you
Yeah.
will, sturdy. And I think it's real. We take that very seriously. And been speaking. A lot of people have come to me, Tim, and said, new administration, regulatory concerns are on the back burner. I think wise and savvy businesses know that the regulatory environment is complex. Not only are we dealing with national regulators, but we operate in 50 different states who have their own regulations, and not all of those have changed. And so I do think the tenor of the conversations with regulators on certain topics is likely to change, and we will see an easing, perhaps a bounce back from a very sharp correction we saw with the prior administration. But that said, we're building the business for the long term and not necessarily whatever is the current the current thing that is being focused on, because as it's never whatever is being discussed today is never the thing that bites you in the future, right? And there's so much. Mortgage was the hot topic in 08, so there was all kinds of regulation that came out, and then the focus shifted more to money laundering, where you've seen major, that's where regulatory focus has really been in the fintech and payment space. So you really need to build your business for the long term, because these things move around.
It's such a great point. And I was in this industry long before 08 and lived through that, like so many of us on the call, for sure. And as much as it was very painful at the time, I mean, Michael, I can remember coming into the office every day and literally going to a website called implode.com, and it was literally just a list of lenders that were closing their doors that day. And it was just,
Wow.
that's a real thing, you guys. And so I'm glad we're through that. Did different regulations need to change? Absolutely it did. Did we maybe go too far on some aspects? Absolutely we did. But
Right.
but to your point, Michael, there's a middle ground somewhere, and making sure that we always manage the compliance aspect of it and regulatory piece is big. It's interesting. I just saw a news clip the other day, or somebody posted something on social that's like, they closed the doors of the CFPB, and I'm like, folks, this is not a green light to be the Wild West. This is not, you know what I mean? It's like, it actually concerns me a little bit, if I'm honest, Michael. It's like, how many people in the industry are now going to be guns ablazing, just doing whatever they think they can do, when in fact, to the best of my knowledge, nothing's changed yet.
Totally. Yeah.
So it's like, I think we have to be cautious. And your comment about the non-QM space, I think it's a really good comment. And obviously, that fits very well for us. And I'll just share with everybody that I was at a conference listening to a gentleman speak, and I actually worked for his company at the time. And he made a comment. He said, the future of lending is going to go to that non-QM space. And if I'm being honest, I sat there in that room and thought, oh my gosh, this guy has lost his mind. What in the world is he thinking? Well, I'm here to admit I was absolutely wrong. And that non-QM space is very significant in our marketplace. And I might add, my opinion is that it's become so popular mostly because agency type loans, by their very nature, underwriting guides, the process to get them done, the cost to get them done, is very prehistoric in nature. Whereas that non-QM space helps solve for that, right?
Totally. Yeah, I think it's regulatory on the agency side. I think also agency focus has been a little bit less on kind of serving that core middle class customer, the customer that we serve at Figure. In many cases, the agency mandate has been unclear, right? Because it's kind of gone through different ownership. And so as a result, I think there hasn't been as much, not to criticize the agencies, they do a lot of good.
Sure.
But I think that there's not necessarily, I wouldn't say that the focus has not been lowering the cost to produce a mortgage that would therefore translate into lower costs for homeowners. That obviously has not been the result. So, here comes Figure, where we're coming up with a new process and saying some of the things that the agency does under certain circumstances probably don't make sense. And we have a process that's going to be a bit different. It's going to be faster. It's going to be lower cost. And there's going to be certain loan types where this makes sense.
Right. Yeah, no, it's fantastic. So I want to shift gears here for just a little bit. And for anyone that's on the call that might categorize themselves as that entrepreneurial, and that's a big word for me, so bear with me, mindset. And Michael, I just want to tap into this with you for a second, because you said earlier you have a long history with SoFi. You also did Brex, and so very entrepreneur ish in that way. What advice, like what advice would you give somebody looking to go down that path? Like really go down a path of doing something that could very well be categorized as a disruptor?
Yeah, I think from a personal perspective, there's probably a couple things that you'd want to look at and say, what are the things that, you know, really are, at least from in my vantage point, make someone successful in an entrepreneurial world. I think the first is and I'm not saying I'm perfect at all these things, but I think one is the ability to see the world differently, right? We've talked a lot about, and this is a large credit to Mike Cagney, who set this up. You know, we clearly see the world differently at Figure. It's a company that looks at process and says, you know, does that make sense? Will the market bear something different? Will regulators bear something different, right? Will technology bear something different? Again, pushing on that three-legged stool. So I think that's one, seeing the world differently. Number two, I think, is ability to sell the dream, right? You kind of have to be able to sell a future. It's not just see the future, but you have to convince people of that future. And there's a marketing element to that. And I think that's a big piece of it, because it's not just about seeing it, but it's also selling it. And I think the third is just working extremely hard, right? There's that famous Einstein quote. But that the reality is if you want to be in the entrepreneurial space, it's a lot of work, right? And so I think if you have those three are the thing that, or at least from my standpoint, what I've seen as be driving success in the space.
You know, you mentioned Mike Cagney, and of course, big fan and co-founder, right, of Figure. And I got to spend some time with him a little bit over a year ago, which I very much enjoyed. And I'll just share with you, and this may sound a little corny, so I'll apologize in advance, but I use the word, and you've used it a couple times on this call, disruptor. And I think there's things that happen in our history that are truly disruptors. The example would be Ford in his car, right? That was a disruptor. It literally changed the way we do things to this day. The cell phone, the internet, these are big disruptors. Now, I don't know that we're a disruptor at that level, so maybe that's the wrong comparison. However, the way we've always done things, and pick any topic, and we're talking about the mortgage industry, we've done things a certain way: Fannie Mae, Freddie Mac, DU, LP, loan processor, do this, fill this out, package it up, submit it, cap markets, secondary servicing, you name it. That's been the way we've done things all along in the mortgage industry, with a few changes here and there. Well, much like our space program, if you will, you built a rocket, you launched a rocket, it exploded, and guess what? You built a new rocket. No one ever challenged that. It was just the way you went to space, right? Until Elon Musk comes along and said, well, why? Why can't I reuse my rocket? Why can't I? And folks thought he was crazy. What are you, crazy? You don't do that. Rockets explode, you rebuild them. Guess what rockets do today? They land and two toothpicks grab them and they reuse those rockets, right? I compare that to with what we're doing. Is it different? Absolutely, it's different, but that's okay. To me, it's a disruptor. When a loan officer says to us, man, when can I do all my loans this way? That's it. That's the magic. Now, will we end up doing all loans this way? I don't know. But the fact of the matter is my belief is what we're doing is very much that disruptor. You think that's a fair comparison there?
No, definitely. I think that's well said.
I think I want everyone to embrace that. It is different. And in fact, Alex and Reef and myself, when we do sales trainings, especially when we onboard new partners, I always jump on the call right out of the gate to really kind of set the stage and create the narrative. And what I say to loan originators all the time is, for the next 30 minutes as we walk through our platform, I need everyone to just agree to set aside every preconceived notion they have about what we all know it typically takes to do a loan. Set that aside and adopt this process. Open mind, going to give it a shot, going to work through it, going to see what the results are and move through. If it doesn't work, I've gone as far as to say, if you run an inquiry and you don't have offers for your clients, it's actually okay. Now, why would I say that? It's okay because it took you 2 minutes. You now have a credit score and an AVM giving you an idea of value. Now shift gears and do what you all do best, and that's educate, advise, and strategize with your client as to what the next best opportunity is. But start with that inquiry tool. That's my, again, process equaling product type mindset.
Totally.
So listen, I don't know if you have anything additionally you want to add that I may not have thrown across you there, but this has been great so far. I think we have some questions. Reef, do we have any questions up in particular to? Oh, just mostly product questions.
You have a blockchain one that's pretty interesting. If Michael, you want to touch a little bit on that. Kevin asks if we can explain blockchain as if he was a ninth grader.
Sure. I think blockchain is a technology, so blockchain broadly is a technology that, I use the phrase truth over trust. And I think it's essentially you could call it a protocol, you could call it a technology, you could call it a way of doing things, a process, however you want. We try to keep blockchain generally in the background, more like cloud, right? When you're using software, you think about, well, how do I use software? It happens to be hosted in the cloud. Generally, that's been the way software has been for the past 10 years. But as a user, you don't really focus on that. You focus on the features. So for us, we don't expect that our partners necessarily care about blockchain. They care about the standardization, the automation, the low cost. But what we're doing is basically we use a set of processes and protocols that ensure that people are agreed that something is true up front. And as a result, it doesn't need to be verified again. So as an example, we might say, okay, this borrower has a 740 FICO, but because you agree to buy the Figure program, you acknowledge upfront the way that Figure etches or hashes that FICO into the database, and you say, I trust that happened. I trust the process that Figure is done, and I don't trust it because I trust Figure, but I trust it because it's the truth, because it's verified, because I can understand how Figure does things in the process that they do. I think another even easier example to understand would be income, right? We don't have an underwriter that's saying, well, let me take a look through this case or this borrower and see if I think that this makes sense as a deal. We say, if the borrower has less than 50 DTI, and here's how we calculate income, it's all automated. If the borrower has less than a 50% DTI, loan goes through. If it doesn't, it doesn't. If the AVM process says that the LTV is lower than 85, it goes through or it doesn't. So it's much more about the truth of that. If the FICO is in between this range or not, and I acknowledge how Figure does it, I accept that process as the truth, and I'm just validating those models rather than saying, well, does the underwriter at Figure, are they a good person? Do they have a track record over time? How does Figure train their underwriters, which is kind of the legacy mortgage process. So that's kind of the spirit of it. And then there's the technology of how that is actually codified day one and then put into the database such that when the loans are moved, that information travels with the loan. But it's really about the process and validating that. So that's where you get the truth over trust.
I love that. And, you bring up the income verification piece, and that's probably the big one for us, right? Again, no underwriters, we have our process. This is what we've established as the truth. And if so, it pushes through and you're all fine. And you mentioned that the traditional lending world of underwriting and that type of thing. Do you know that it still exists in the agency guidelines right now today, that you'll see a guideline, but then it'll say underwriter discretion? So to your point of, good person, not so good person. I mean, it literally can come down to that, which actually is, I will tell you, which is what muddies the waters in that typical traditional loan sense. So I love that. We've got a couple questions here. Tim makes the comment, the rate seems fair compared to most HELOCs. Thank you for that, Tim. You have a hard time selling 5 points. You're talking about the 499 origination. Tim, definitely reach out to our team in the very near future. Let's grab some time and we'll walk you through that, because you don't have only that as an option. You have additional origination fee options as well, lowering, and then the rate comes up as a result. So think of that almost from a buy down perspective. The higher the origination, the lower the rate, type of thing. Yes, Tim, we also will do non-warrantable condos. And maybe the best way to say that is we're actually not going to ask for a condo cert or an HOA cert. If the property comes back and the AVM is what it is, we're moving forward. And then someone asked, is there any plans to lower the minimum FICO score in the near future? You know, Michael, I don't know if you've had that come across your desk at all. It used to be 620. We went to 640, and I'm not sure where we're at on that, you know, as far as future.
Yes. So I think right now our plan is to actually start with better pricing in the lower FICO in the near term. And then from there, based on performance that we see there, potentially lower it a little bit further. So yes, we're working on that.
Okay, awesome. And then John asked the question, do we have marketing flyers that can be branded with myself and the LO QR code for applicant? Number one, John, commend you for asking the question. It's a great question. And I'm also happy to report that myself and team just had a meeting with our new vice president of marketing, who I'll credit Michael for bringing on board, and a real effort. Her name is Betty, and a real effort being made right now to create marketing documents that are brandable, that you can literally just drop your logo in and drop your email signature in, type of thing. Some of them are already available. So again, please make sure you reach out to myself and team, and we're more than happy to help you with marketing materials. And then there is the question about AVM, and we can actually, Michael, you can actually talk about this a little bit. One question is here, some $1 million mark type properties, and the appraised value has been pretty far off. Are we looking at any other way that these can be booked, or secondary level, or different opinion of value? And I think you might have some comments on that.
Yeah, I mean, as you know, Tim, we do offer the loan officer the ability to do a broker price opinion as well. So I think we've introduced that relatively recently.
Yeah, and actually, and by the way, maybe we've missed it, Alex, Reef, I don't know. We currently have a platform or a process in place that I should say that if no AVM results are found, it will automatically trigger for you, the loan originator, to estimate value. That'll order the BPO,
Right.
and with any luck at all. Now, what we've been working on, and it sounds like we're getting close to going live, is even when there is an AVM, having the ability to challenge said AVM with the BPO. Is that what you're thinking there, Michael?
Exactly.
Yeah. So, and I don't know if that's live yet, but it sounds like it's awfully close. So we'll dig into that. Actually, team, if you can remember, let's make sure we dive in and see if that's things. It's actually good news, bad news. I will just share with everyone that I made a comment to Anthony Stratus a couple weeks back. I said, holy smokes, when it comes to product and process and everything, I feel like our engineering and product team has their foot mashed down on the gas, you know, rolling things out almost faster than we can keep up, you know. So
Exactly.
again, kudos to you, Michael, for driving that initiative. So let's see here. Is there anything else? Is there a market or product where we put a DSCR loan in first position and then add some over collateralized Bitcoin or Ethereum to allow buyer to close without cash down payment?
Huh. Well, we do.
Yeah.
We have kind of in pilot a HELOC, not a DSCR product, where you can borrow in Bitcoin, but so not exactly the use case, but we are, because we have an interest in blockchain. You know, we are interested in those types of products. So more to come there.
Yeah, and by the way, this leads us to our very next question. So Jill, thank you for asking it. She says, I get a lot of questions, especially from realtors in Silicon Valley, about crypto/Bitcoin loans for real estate purchases. She says she missed it if we talked about it, and she'll catch up separately. So one, I'll make this comment. Jill, please connect with us, because I would love to engage you in this conversation, if it's okay with Michael here, because we're working on that.
Sure.
You know, and so we'd love to have some areas where we can say, okay, let's give it a shot. So that'd be great, Jill, if you can reach out to us on that. And then when will bank accounts at BMO be accepted? Plaid does not support those currently. Now I know Plaid we facilitated adding Fidelity. Now I know that's
Right.
not BMO, and I believe we're also adding one additional connectivity source. Is that right?
Yes. So I think we should come back more specifically on that, but
Yeah.
I wasn't aware that Bank of Montreal wasn't an option, but I think we want to come back on that because I know in certain areas of the Midwest that's popular.
Yeah, no, that's fantastic. I think we skipped a question there, Reef, but then it's gone. So, well, listen, here's the reality. We are coming up to time. Everyone knows that as attending or even registering, actually, here comes the question. In Florida, we seem to have a tough time with driver's licenses and have to have them uploaded multiple times. By the way, it's not just Florida. What's the other one, Reef, that we see? It's the color of the driver's license.
Arizona is the other one.
Arizona, Florida. Yeah. And actually, Michael, you might be able to talk on this as well, but I actually think we're testing kind of a workflow for that currently. I saw
We
some
are currently
information.
testing a
Yeah.
workflow for that. Yeah. So we definitely hear the feedback. I mean, we're not perfect. I think the important thing that we can be perfect in is listening and trying to improve.
Yeah, and so Mark asked the
Yeah.
question. Here was this question. He's with many different investors that are approved with us. What is the difference with using one investor for another? You know, again, Mark, maybe we can talk offline about that from a pricing and product perspective. There shouldn't be any. However, what it comes down to, in my opinion, is going to be your service levels and where do you feel you're best supported. You know, and we'll definitely help with that. So definitely reach out. So. Listen, I know we're just right about at time. Michael, you're a very busy uh,
Well,
man.
thanks so
So,
much for the opportunity, Tim.
Michael,
It was
thank you.
great.
I mean,
Yeah, thank you
really,
very much for
this has been great. I hope everyone has gotten a lot out of this. Thank you for the insight, Michael. I think 2025, the future is bright.
Right.
Remember, everyone registered and attending will receive a recording as well as any follow-up materials. Alex and Reef, please make sure everyone has our contact information as well. And we're anxious to help. So, Michael, thank you again.
Thank you guys. Appreciate it.
Yep. Have a great rest of your week, everybody.